Ladies and gentlemen, good day and welcome to DLF Limited Q2 FY24 earnings conference call. We have with us today on the call Mr. Ashok Tyagi, Whole-time Director and Managing Director, DLF Limited, Mr. Vivek Anand, Group CFO, Mr. Sriram Khattar, Vice Chairman and MD, Rental Business, Mr. Akash Ori, Joint Managing Director and Chief Business Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vivek Anand. Thank you, and over to you, sir.
Thank you. Good evening and welcome to DLF Limited Q2 Financial Year 24 earnings webcast. Thank you for joining us today. We are happy to announce that our business delivered a strong performance across parameters. I will start with the financial highlights for Q2 Financial Year 24, DLF Limited consolidated. The consolidated revenue stood at rupees 1476 crores, gross margin at 57%. EBITDA stood at rupees 591 crores, reflecting year-on-year growth of 19%. Net profit at rupees 629 crores, reflecting year-on-year growth of 29%. Record surplus cash generation from operations at rupees 1,147 crores. New sales booking for the quarter stood at rupees 2,228 crores, in line with our guidance. Our new products and existing inventory continue to evince strong consumer interest. Our super luxury offerings, the Camellias and DLF 5 Gurugram, saw healthy demand during the quarter and continues to set new benchmarks, indicating strong demand for high-quality residential products backed by a strong brand. We continue to see sustained demand momentum across all segments and hence keep a positive outlook on the housing cycle. Our new product launches that have been planned for the second half of the fiscal remains on track, and we remain committed to bringing calibrated supply across our key markets and leverage this growth cycle. Collections continue to remain healthy, resulting in record cash flow generation during the quarter. Consequently, post-dividend payout of 990 crores, we achieved a net cash position of rupees 142 crores at the end of the second quarter. We have therefore delivered on our commitment to achieving a net debt zero position. We will continue to further strengthen our balance sheet through consistent cash generation. I'll now move to the financial highlights for Q2 Financial Year 24 DLF Cyber City Developers Limited consolidated results. Rental income grew to rupees 1,069 crores, year-on-year growth of 9%. Consolidated revenue of rupees 1,463 crores, reflecting a 7% year-on-year growth. EBITDA stood at rupees 1,109 crores, a year-on-year growth of 6%, and a net profit at rupees 416 crores, reflecting a year-on-year growth of 17%. Our office occupancy improved to 91% at the end of the quarter versus 88% in the previous quarter. Occupancy across the non-SEZ segment has inched back to 97%, demonstrating the high quality and inherent demand for such products, while SEZ occupancy stood at 85%. Our new office developments continue to garner occupier interest and consequently have achieved a pre-leasing of 89% across our two new office complexes, DLF Downtown in Gurugram and Chennai. Retail business continues its growth trajectory, and our progress towards expanding our retail offering stays on track. We expect construction of a large retail complex in Gurugram to start during the fiscal. I am happy to share that US Green Building Council recognized the sustainability achievements and commitments of our rental business at the Green Building International Conference and Expo held in Washington, D.C., USA, and recognized the business as a world leader in LEED Zero certification and LEED for existing building platinum certified space. This recognition is a testament to DLF commitment towards sustainability and adoption of green building practices in the country. We strongly believe that our healthy pipeline of new products, along with a resilient as well as a steadily growing rental portfolio will result in delivering consistent and profitable growth across our businesses. I will now like to hand over to Sriram to say a few words, right, before we open this to Q&A session.
Right, thanks, Vivek. It gives me a lot of pleasure to share with all of you that the US Green Business Council at their annual expo recognized DCCDL and DLF as world leaders in sustainability. And I'll just read out parts of the facilitation that they did there. It says DLF has become the worldwide leader in both LEED Zero certifications and LEED for existing buildings, platinum certified spaces, which are extraordinary achievements. It also goes on to say that as the largest public listed real estate company in India, your actions and leaderships are influential and inspirational. You are setting a standard for sustainability excellence to which others may aspire. I am honored to recognize your creating a sustainable built environment in the Green Build International Conference and Expo. US Green Business Council could not be prouder to work with a global partner like DLF, leading the transformation and regeneration of the built environment across India and throughout the world. I think this was an extraordinary achievement for us, recognized by the highest body in sustainability in the world. And we continue on our journey on this. We have got the LEED Zero for Waste certification for our cyber city in Hyderabad. And now we are replicating it across all our projects. And this is in line with our long-term goals of being leaders, definitely in India and preferably across the globe in sustainability. Thank you, Vivek. Back to you.
Thanks, Sriram. Thank you. Yeah, we can open it up for Q&A now.
Much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Saurabh Kumar from JP Morgan. Please go ahead, sir.
So congratulations, Team DLF, for achieving this positive net cash after guiding for almost 7 years. So seems to be a seminal quarter for you guys. So I had a few questions. So one is, on Camellias, Akash, so 14 apartments for, 712 crores. So fair to say that the pricing has now gone to 75,000 rupees. If I just kind of do some back calculation on this unit sales. So that's the first one. The second is on your cash flow. So, your construction spends are still relatively low. Now, as your construction spends kind of move to and you have 30 million square feet under construction. So as your construction spends maybe ramp up to maybe 2,500 crores a year, would you think that your cash flows now reset still to this 1,100-1,200 crores that you are kind of generating right now? Or is this, in some sense, peak cash flow, what we're seeing? The third is essentially just on your debt. So what's the logic of keeping 3,000 crores of debt and then 3,200 crores of cash on balance sheet? That I could not finally figure out. And lastly, one for Mr. Khattar. So it seems to me, basis your presentation, you don't have any space available for marketing in the non-SEZ space in DCCDL. Whereas you may have some vacancies in SEZ, but the non-SEZ space is not available. So what are your thoughts in terms of, getting that space to market, because that's where the demand seems to be. So these are a few ones. Thank you.
Okay. So thanks, Saurabh. So in Camellias, we are above the 75,000, you're right, mark. And now, as you know, we've got the last few to go. But I'm sure you would have read the Economic Times article. So very happy for Gurgaon to have reached that 100 crore mark for one apartment, and I think that is something that is obviously everybody is quite excited about. So yes, Camellia is upwards of the number that you mentioned. So what you actually mentioned was the previous pricing, and then it's gone up further. It's closer to what was being reported, and the only difference being that we have a price distinction between lower, mid, and high floors. So that's where we are with Camellias, and I think you've been part of this journey. So from where we started to where we are, and thankfully there is a it's backed by not just speculation, it's backed by solid demand, and therefore the new Superlux product that we were talking about earlier also, where we've also mentioned about it in our guidance. So based on the services, operations, stroke demand, and happy to also mention to you that today Camellias has become the benchmark for the country, and very proudly so. So not only here but anywhere in the world, when real estate is mentioned, I think Camellia today is being referred as an India product. So I think that is a bigger satisfaction than just reaching the 100 crore mark. So yeah, that's where we are. So
Yeah. Hi, Saurabh. On the construction spends, first of all, last year, our total spends, annual spends were close to 1,200 crores. First half, we've spent 650 crores. And the second half, our estimate is we'll be spending close to 1,000 crores. So on an annualized basis, we'll be spending around 1,700 crores. Second half, we expect to start giving possessions for a large part of our floors. So that will increase our spending. Plus, the Arbor project pace is going to pick up in the second half. So there will be a large part of outflow coming up in the second half. The second part of your question was cash flow from operations. Yes, in the first half, we have achieved a cash flow from operations of 2,000 crores. And if you remember, the guidance I had given was upwards of 3,000 crores on an annualized basis. So yes, considering our performance in the first half, I see an upside in our cash flow operations on a full year basis. Then your other part of the question was, what is the logic of keeping 3,000 crores of gross debt when we have a cash of 3,165? Just to remind you that out of 3,165 crores of cash, the free cash which is available is only 450 crores. Rest of the cash is logged in RERA escrow accounts, right? So therefore, we'll have to really live with this gross debt till the time we are able to generate free cash. And we are confident that as we are able to mature our projects and we are able to give OC, right, we'll be able to generate free cash, and that will be utilized to repay the debt.
Yeah. So Saurabh, on your question of space available in non-SEZ, yeah, it's with the complete modesty that we have sort of done well in the last few quarters in terms of leasing. In fact, in downtown in Chennai, where there was about 250,000 square feet of space that was left, that was also committed yesterday, and therefore downtown Chennai is also fully leased. So the space that we have available now is about 3.5%, which is about 6-7 lakh square feet of space. In addition to that, we have some of the hard options which the tenants may not want to take up, which keep coming up, which will get released. And my sense is they will get released at rates which are current market rates and higher than the rates at which the hard options were. Three, as we our program is to complete downtown 4 in Gurgaon by the end of 24, calendar 24. And in the first quarter of 25, the Atrium Place, which is our joint venture for about 3 million with Hines, in which DLF has 2/3 stake, will start getting completed. So now the leasing and operations teams are working on marketing Atrium Place, and they have a head start of more than a year before the first building comes up. to lease. In addition, this has also enthused us, and we have marginally accelerated the start of construction of phase 2 in Taramani, which we should start in the Q4 of this financial year. And we are also starting the construction in the next few weeks on the phase 2 of downtown in Gurgaon, which is a multi-use development of about 8 million square feet, 8.5 million square feet, with a 2.7 million square feet of a mall, a destination mall, and about 5.5 million square feet of office towers.
Thank you, sir. So just one follow-up back to the residential side. So, I mean, how concerned are you about the sharp price rise you're seeing in Gurgaon? You know, is there a concern that prices go up too much and then that basically impacts affordability, or that's not a concern for you right now? So, thank you.
Sort of prices going up. See, there is a latent demand. As far as concern is concerned, you know, you're right now referring to the real estate thing for resi, but tell me where the prices are not going up, whether it's, you know, eating out in a hotel or a air ticket or even a holiday. So I don't think, see, right now what is going up, the only thing is that there is a demand for better products and good products, you know. So prices that are going up, if you see this carefully, is going up for products which are in a certain genre, you know, so luxury and above. So if the post-COVID, what has happened is that the demand and the spends have kind of changed to a certain habit that people have got into, in terms of, you know, they realize that life is finite and all that, so therefore live it up. So the demand for better, bigger homes is there today. Again, I'm not going to get caught into this luxury definition and all that. Everybody kind of misuses it. But I'm saying better, bigger, more spacious homes is what the demand is today. And therefore, the price is a resultant of that, sort of. So it is not something which is, you know, just something in the air that, you know, you're talking about a smaller apartment with certain price points. With inflation, with price points going up everywhere, this is where it is today. And buying a residential real estate today has become, I've repeated this and I'm going to repeat it again, has become a priority for people to kind of, you know, it is the number one priority today for most of the people. So thankfully, a lot of people who were in the on the fringe and all that, and would always live on rentals and do other stuff, have also jumped into the fray. And I'm talking about the younger crowd, which is very heartening to see that you know, the 30 to 40 bracket is today making real estate purchases. But the good part is that everybody is wanting to punt and take bigger homes. So therefore, the rise in price points today are reflection of a certain mindset which is changing on ground, sort of. So it is not about speculators. It is not about what used to happen 10 years back. These are people who want to buy homes for themselves. And if you see the rentals, if you see rentals are a good parameter for what is happening today. And also, if you see the habitation charts, there are various reports in Gurgaon which will tell you that most of the condominiums are now over 90-95% inhabited. So I think this is what you should see. So at this point in time, I won't be concerned about that. But let's see how it goes, and obviously, you know, things will settle down even further as we go along. But if you're saying that, you know, it's a all I can say is that there are enough people out there right now for wanting to better their experiences, and I'm looking at those people. They're not only just first time, not only people who are habitual real estate investors, but also a lot of first timers, which is very heartening to see. Saurabh?
Thank you, sir. Thank you, Akash. I'll come back in the queue for questions.
Thank you. Our next question is from the line of Kunal Tayal from Bank of America. Please go ahead.
Sure. Thank you. Two questions from my side. There would be about 19,000 crores worth of launches in the next 6 months, and after which, you're largely left with a pipeline of about 24,000 crores, and seems like, about 1 year's worth of launches on the new base. So, is there a thought process already to start planning for the next phase of launches, which should come by for FY26 onwards? So that's question number one. The second one is on the office side. Your IT services tenants have actually been very stable, something that we've not seen from the peer set. So, is there any indication that you have from them that there is no intention to vacate any existing space? Thank you.
So the first question is, see, we plan for almost 3 years ahead, and based on which geography we are getting into and what we are doing. So that as an exercise we continue to do internally. So yes, visibility may be shown for maybe a year or year and a half, but we plan 3 years in advance of what we are intending to do. So if I've been able to answer that question.
So Kunal, I mean, while we have sort of documented the pipeline for the year after, it's not that our planning process is sort of shutting down. So we will have we have enough land bank, and we will have a constant stream of pipeline flowing out.
Yeah. Kunal, on your question of indication from IT services companies of any vacancy, that has sort of ebbed, and I dare say the impact of COVID is now behind us. This has been helped by two or three reasons. Reason one is that during COVID, the space take-up was poor to a lot of exits, and therefore, but at the same time, the hiring was very good, and therefore that is now coming back in terms of tenants either not leaving spaces or asking for additional spaces. Two, what has happened is that some of the larger IT companies are no longer looking at 80 square feet per desk, etc., which had become the norm pre-COVID, and would like to have more network, collaborative, open spaces, and therefore the demand has gone up to 100 and the size they look at is about 120 to 130 square feet per desk. However, having said that, I may add a word of caution here that the companies are still working on their individual hybrid models, and that is something which has not yet stabilized. One thing is sure that it's going to be hybrid, but what form or shape the hybrid takes is still being worked out by companies. And there are companies who want to hot desk for hybrid. There are others who want to give individual desks for hybrid. There are others who say even if it is hybrid, they have to cater to peak performance. Number one. Number two, while attendance in our IT parks has improved dramatically, uh, the larger IT services companies till now have been able to manage the increased manpower in the existing spaces. And last about a quarter or so, we are seeing the green shoots when they have now started planning for the next year and 2 years and started looking for space. So if this come back to office starts working in a positive way, and India is far ahead of the West on that, then I see that the demand from IT services will go up. The issue of vacancy then will be much more subdued.
Yeah, pretty encouraging. All right, thank you so much.
Thank you. Our next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much, and congratulations on good numbers. My first question is on the DevCo's commercial portfolio, the DLF 5 and City Center. The GAVs there seem to have fallen on a quarter-on-quarter basis. Can you comment what's happened there?
The GAVs have fallen. Yeah. So honestly, the GAVs keep on getting adjusted basis the rentals. So this time, to be fair, on some of those assets, we have done a very thorough analysis of the rentals that have been, that are not there just today, but the rentals that those buildings have been earning for the last 6 or 7 years. And I think that is the reason why the GAVs may have been slightly adjusted. As you know, these numbers have no bearing on the balance sheet or on the balance sheet or P&L
Yeah, no,
for
I
the years.
understand. It's a 20% fall, which is what bothered.
Yeah.
So just wondering
So
what's
maybe I
the
think the
thought
part
process.
of the devil is that the earlier number may have been a slightly optimistic. Is the best that I can say, because this year we've done a very scientific thing of what the rentals are, taken a full 9-year cash flow, discounted like a proper private equity, and then come with these numbers. But again,
Understood.
tomorrow if one were to go out to sell it, I'm sure we could get 50 crores less than this or 100 crores more than this. That will be a bilateral coordination, bilateral negotiation issue. Not that we are in the market for selling any of these.
Got it. And second, DCCDL used to give dividend typically in Q2. This time there was a dividend, but very small. So any thought process behind that?
No. So Puneet, I think if you go through the cash flow of DCCDL in the last 1 year, DCCDL gave a hefty dividend in the end of Q4, which really was a substitute for the final dividend. So hence the final dividend was a very small one. DCCDL has again given its half-yearly dividend, but that obviously has come at the end of September, so that's come in early October, when DCCDL did their second quarter results meeting. So DCCDL continues to be in the cycle to give 2 dividends a year, which is what we have been attuned to for the last couple of years.
Okay. So the cash would have come in October instead of September.
October, absolutely. Because as you would appreciate that once the first half results are declared, then the company declares the interim dividend for the last 6 months.
I understand. Thank you so much. And secondly, on the cash tax liability for the DEFCO, that seems to be quite low. How long do you think will that advantage persist?
The cash tax liability.
Yeah, the cash tax in the cash flow statement.
Part of this, Puneet, is linked to the massive change in accounting policy that happened when the new Ind AS accounting standards got notified. In that sense.
Yeah.
So part of this is linked to that. I mean, we do believe that in our tax returns, we don't foresee a significant tax liability for the next couple of years.
Okay.
But these are things which are constantly litigated between us and the department, which is par for the course. But we don't foresee a significant amount of cash outflow, at least for the next couple of years. Am I right?
Yeah, absolutely.
Understood. That's helpful. And lastly, the collection run rate has gone up to almost 2,300 crores. Is that a sustainable run rate, or was there some completion-related additional collection that came through?
So Puneet, if you remember, the guidance I had given on collections was a growth of almost 13 to 15%. And that meant in absolute numbers of close to 6,400 to 6,500 crores.
Right.
So yes, collections have been good in first half, and I see a potential upside coming in collections, and the same upside I expect will flow in the OCF as well, which I clarified in the earlier part to Saurabh.
Understood. And you lastly guided that construction costs would go up by roughly 50% over the previous year. That should be the upper limit, right?
Yeah, 1,200 crore of last year going close to 1,700 crores. So that will be almost a 40% increase. A large part of it, you will see it in the second half.
Understood. That's very helpful. Thank you so much.
Thank you. Our next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi, good evening. So just on the on the phase 5 side, you talked about pricing getting closer to 100,000 per square feet. When I just look at your slide 10, where we are talking about 5 million square feet of luxury valued at about 12,400 crores. I mean, that's like 25,000 square feet, right? So does this number see a significant upward revision? Because I believe the bulk of this would be phase 5.
So what you are seeing is for a ready to move in or ready apartments. And as far as valuations is concerned, definitely you will see there is a tremendous upside there already. And as far as this is concerned, if you go back to what it was earlier on certain price points at launch, they were, if I just go back 7 years, there was an X price, and today that price is about 4 times that value. So I wouldn't want to speculate on future values, but all I can say is there is a reasonably good upside to what you have just mentioned. Right now, as what Mr. Tyagi was saying, that when we come closer to launch, that's when we make the pricing and we true up the whole thing. But at this point in time, this is just a guidance given.
Yeah.
But as I said, you will obviously put two together also. But there is a good reasonably positive outlook there. But again, we are not in the numbers game there in terms of this is going to be a staggered kind of a launch as super luxury deserves, and there will be price points at various intervals that will go up, based on how much stock we bring in at that point in time, and that's how we'll be approaching the DLF5 story.
And just to add to what Akash said, Kunal, see, when we had given this guidance, towards the end of last fiscal year, and a lot has changed in the last 6 months. And therefore, in keeping it short, yes, these numbers will undergo a change, and there is a potential upside to this number.
Yep.
So again, Kunal, I think to what Vivek and Akash said, absolutely, these numbers will undergo a change as the product and the pricing gets screwed up closer to the launch. I mean, we had the option. Actually, we had internal debate of whether we should change these numbers now or as they are closer to launch. Honestly, I mean, you know us as a company, we are conservative people. We don't. I mean, we are not in the business of trying to milk every guidance upside. From a market standpoint, and so we are okay with this. But obviously, these numbers will undergo a positive change as we hit closer to launch.
Got it. And secondly, can you just comment a little bit on the new launches status in terms of where we are in terms of approvals and timelines, for example, for Sector 76 and also for Phase 5?
So in 77, that's Privana, the approval process is on, and this is a Q3 end launch, and so far so good. And the other one you mentioned was the DLF5 one, right?
Yeah.
So that is also on track for a Q4, but that was, as we had said, Q4, Q1. So that is also on track. So far, based on what we are doing internally, all approval processes are on track. And also for the Valley Orchard in Panchkula, the SCO in Gurgaon. So all the approval process and the right now we are meeting those timelines as we speak.
So Panchkula will be in Q3, just confirming, right? Panchkula has been
Yes.
Q3?
Yes,
That's right.
And DLF5 will be in Q4?
Yeah. Q4, Q1, yeah.
Oh, okay. Q1, there's a possibility of it slipping to Q1.
Not slipping, it's part of the thing because this is, as you know, it's a very big project, and it's coming after Camellia's was 2014. This is 2000, it's almost a decade. So these products require that kind of an attention. So 1 month here, there won't really matter, but I'm just saying you should know where we are as far as the planning is concerned. But so far it's on track. It's just that we'll take that call closer to Q4 or maybe in the beginning of Q4. We'll know exactly, say by January we'll know which route to take.
And either way, Kunal, our sales guidance of 13,000 plus is under no threat. Frankly, even if one of these projects tends to slip by a few weeks here and there.
Sure, understood. And my last question is on I think on the utilization of free cash flows. We're clocking almost 1,100-1,200 crores a quarter now, and with debt behind us now, how should we look at it? Incrementally going ahead, because we'll end up piling a lot of cash, in coming quarters and years.
So I think, as Kunal, I had said earlier, it's very clear. I think the first priority is to really generate as much as free cash as possible. And while we have 3,100 plus crores of cash, the free cash available is 450. So the first priority is to really make sure that we complete the projects, get the NOCs, and convert that into free cash. So once we have free cash, yes, one of the things we could possibly do is to really repay some of the debt. Second is to really put the cash behind growth, right? And third is to continue to reward the shareholders. I think that's consistently what we are following.
Sure, sure. Thank you so much.
Thank you. Uh, our next question is a text question from the line of Parikshit Kanpal from HDFC Securities. Can you update us on the status of the Tulsiwadi and Andheri project?
Okay, so the Andheri project is on track. As we had mentioned last time, we are in the slum rehab is making very good progress. I think of the first phase of 30 odd storied slum rehab, 27, 28 stories are already ready, and we stay on track for a potential launch around, I'd say, definitely before June of 24. So that does look to be on track, and the first phase should be about 1 million square feet of launch, give or take. Tulsiwadi, has been in a significant legal mess, and it's just gone further deeper in that. We had made a bid for acquiring 100% of the shareholding of the company to the then lender PNB HFL, who was unable to give us possession of 100% of the shares. Then they did a they sort of sold off the loan to an ARC, which sold off the stake to an entity. We and Shapoji Palanji both went to court against the completely non-transparent method that the process was done. The Delhi High Court has made some scathing observations and has put all the shares in suspended animation. And I think both us and SPCL are exploring the complete legal options on both counts: A, to restore the shareholding of the company back to where it should have been, and B, to ensure that our outstanding debt from that company to us is not jeopardized. So I think we are on extremely strong, solid, legal ground. Delhi High Court has, by and large, in their interim conclusions, supported our stand, and now I think it's just a question of sort of taking that legal issue, through all its right. I guess course. I think we just landed up, in some sense, in an unfortunate situation of what could have been a great project, but we do hope that we'll eventually be able to come out of it without a financial loss, maybe with the shareholding also restored, and we are in the midst of that legal battle. Andheri project is working on track.
Thank you. Our next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thanks for taking my question. First is to Mr. Khattar. So I think very good leasing quarter across the operational and the under construction portfolio. Just wanted to get a sense of that leasing. 3 lakh square feet each leased out in both SEZ, non-SEZ space. Where is the demand exactly coming from? Is it the existing tenants expanding, or are we also seeing some new tenants, specifically in SEZ spaces as well?
So I will start with the non-SEZ spaces. The demand is coming from new tenants and existing tenants. And as I have mentioned earlier in the earlier analyst calls also, the majority of the demand continues to be from the so-called global capability centers, which find India a very compelling location to look at because of its strong digital backbone, high quality, global quality infrastructure, and office spaces at a fraction of a cost, and very high quality, young English speaking, skilled manpower. Uh, they are expanding in the country, and I personally believe that in the next 4-5 years they will be a major contributor to the growth of the offices market. And there in downtown Gurgaon, we have been able to establish a rental of 150 rupees, and in downtown Chennai, we've been able to establish a rental of 100 rupees. In the SEZ space, fortunately, we are slightly better off than what the competition is. We have a vacancy of about 14-15 odd percent. Uh, we believe and we are given to understand that the Ministry of Commerce is in the final stages of allowing floor-wise denotification. And once that comes, we believe that the demand for our quality spaces, even in SEZs, will go up. And over the next 4-5 quarters, we'll see a fair amount of traction there also. So to add to this, what Saurav asked in the beginning as to where the stock is, we believe that floor-wise denotification will also give us about 800,000 to a million of stock in the next year or so.
Sure, and just to follow up on that, SEZ space is also seeing demand from new tenants, or it's just existing tenants expanding?
It's a combination of both. It is existing tenants expanding, say about 60-70%, and 30-40% new tenants coming.
Got it. Got it. And just one question on camellias again. Whether the inventory that is there right now in our slide, it's repriced to 1 lakh a square feet, or what's the pricing assumption there? Because I'm seeing, like, if I add up the sales that we have done this quarter plus the inventory that is there balance, there's a 20% jump in the inventory value. So what's the pricing assumption now in the camellias?
No, so pricing is, as I mentioned earlier also, it's the lower, middle, and higher floors. Higher floors go upwards of the number that you're talking about. The lower floors are basically based on that. There's a preferential location thing, which is a 20% difference between the three segments that I just mentioned. So that's where the valuations will be. So some of the inventory that is left, some of them are on a higher floor, some mid, and some low. So based on that is what the valuation is going to be. So if I've been able to answer that for you.
Yeah. So the range would be. Sorry, you can go ahead.
I think so what we've done is that the current value of inventory is based on the average price realization of Q2, right? So, and what Akash is saying, that the current price is certainly more than that. So answering your question, right, there will be a potential upside there in pricing.
Got it. That answers my question. Thank you. That's it from my side. All the best.
Thank you. Our next question is from the line of Abhinav Sinha from Jefferies. Please go ahead.
Hi. So a couple of questions. Firstly, on Privana. So is there a rethink on the product that we have there versus a mid-rise that we were envisaging?
No, so product, not rethink in that way, but there were a couple of towers of high-rise in Privana. So it was, that's just been some more towers basically have been added as high-rise to the mid-rise scheme. That's all. So this, in the plan, there was already high-rise, in a mix of that with some mid-rise. But right now there is, I think it's just, we've added more high-rise to the scheme. Yep. So as we feel that the demand there is, more. And then of course, the way it's coming out, again, it's, if I can call it an Arbor 2, because it's the same kind of spec and layouts and all that. The approach infra, closest to the biggest green lung in Haryana. So for a home, it can't be more perfect, so that's what it is right now, and it's just gotten. I mean, to answer that, it's just now the product is enhanced even more, and therefore, That's what it is.
Right. So we look for similar sell-throughs, and does it also lead to better, let's say FSI utilization there, or that's not the idea here?
So, Abhinav, really, what we are launching, there right now is barely covering a quarter of the total site that we have there. So we have an enormous degree of flexibility in terms of of how to use the maximum FSI available on that site. So I think what the product changes that Akash is alluding to have been more driven by A, the success of Arbor, and B, by what I think the customers today are looking for versus just it's not a standalone site where if you don't build now you lose the FSI for life, because this is a part of a far bigger land parcel. But yes, I mean to Akash's point, currently what we are looking at is a product frankly far closer to Arbor than originally envisaged.
So adding to Mr.
Right.
Tyagi's point, because just for you to put it in perspective, you can, I mean, only a colloquial way of saying it, it can be called a DLF 6, but there's so much to do there, there is so much to do there because it's a good parcel, and we'll kind of build it from scratch.
Okay. So secondly, and congratulations to Mr. Khattar on the strong performance we have seen. So Tyagi sir, my question is, does this bring us closer to the REIT offering now, considering we are done here? And the SEZ, you are also very positive on the Ministry of Commerce, giving a favorable sort of amendment here very soon.
Unfortunately, Abhinav, what will bring us closer to a REIT is the performance of the other REITs and not performance of Mr. Khattar. and those don't seem to be, doing significantly better. But to be fair, as I think we have said umpteen times in the past, we are now ready from a structuring standpoint to almost press the button within a 180-day period of whenever the two shareholders decide. I think it was in some sense, in a pause mode for a variety of reasons, including COVID and the aftermath of COVID, the vacancy, overhang that it left, the SEZ pieces, and the entire interest rate scenario. I think we're still possibly a few quarters away from the interest rate scenario turning benign, which actually is the right time for a product like that. But clearly, I mean, monetization at some stage, I'm sure will happen. It's just a question that, I mean, that both the shareholders, while they are aware and cognizant of that, I don't think they are right now, if I may use the word, in a tearing hurry to do that, But at some stage, I'm sure that there will be an interesting monetization option that will be executed.
Got it, sir. Thanks and all the best to the team.
Thank you.
Thank you. Our next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead, sir.
So thanks for taking this follow-up. So just had a few more. So one is, your staff cost is down quarter on quarter. What explains that? I mean, given the performance of the company. So that's first. The second is, with Dwarka Expressway now finally completing, sir, is there a lot of, investor inventory, whatever gets unlocked, and that kind of comes to the market, and how does it interact with your new ground supply? If you have any thoughts about what Dwarka Expressway completion does to new ground. So that's the second one. And thirdly, Tyagi sir, you have kind of, your sales guidance has gone from 12,000 to 13,000, and this call 13,000 crore plus. Would you want to kind of give a range as to where you see the number, or should it be better because every quarter now you're
Saurabh, I will answer your last question first before I defer to Vivek and Akash for the balance piece. We have always maintained a guidance of 12 to 13,000. And even in our last call, I had mentioned specifically that there's an upside risk to this number, which is what I mean. I believe that now maybe the upside risk is slightly stronger. So hence I added the plus to 13,000. But you won't nudge us into giving a sharper number than that.
Great. Okay.
Yeah, staff cost, Saurabh, staff cost for the full year is expected to be somewhere close to 560 to 570 crores. So I think you are referring to quarter one and quarter two staff costs, where quarter two staff cost has dipped, right? Is
Yeah,
that,
yeah,
yeah?
yeah.
I think that's more to do with phasing of spends. I think quarter one has a larger provision for sales incentive, right? Which, see, the sales incentive normally we book with a lag of 1 quarter. So quarter one had impact coming from quarter four sales, which was the highest quarter in the last financial year. And quarter two has sales incentive booked for 2,000 crores of sales, which happened in quarter one. I think that's the only reason why there is a difference. But on a full year basis, you can take a 560, 570 crore kind of a number.
And Vivek, shouldn't your gross margins be higher because Camellias was booked into revenues? Like ideally, wouldn't have the gross margins been higher than the 57 we are reporting?
No, so you're talking about second half. I didn't get your question.
No. So this quarter we would have booked these Camellia sales, right, into revenues.
Yeah,
These
yeah,
14 odd
that's right.
apartments, and that's at a higher price. So the gross margins on those sales will be like, north of 70%, I'm guessing. So your gross margins which you're
Yeah.
reporting is 55, 57.
So Saurabh, what I've sold today is at a higher price and therefore at a higher margin. Though that margin will get recognized when we'll issue the possession letters, which will
Okay.
happen some time away. Now, this
Okay, got it.
57% margin is for the possessions I have given during the quarter and something which was sold a year or 2 years back.
Got it. Got it. Thank you, sir. Got it. And lastly on the Dwarka Expressway.
Yeah, with reference to Dwarka Expressway, as you know, Saurabh, for over 5 years of whatever inventory that was there, that is, has been still hanging around there, and that is more of a investor market than anything else. So it kind of sometimes worries me. Next visit here, you should go visit it also, because it's more of I don't know, who's finishing off what payments there, but everybody, is lured to make that initial transaction. And post that, what's happening is, whether it's habitation or whether it's anything else, that I feel right now is contributing to what the other developments are seeing, and especially in terms of movements and all. So I mean, at this point in time, too early to comment. But whether it's conflicting or not, each markets are different. We are completely, as you know, sold out in ROG. I will only know post that. But each one of our projects kind of work on a different parameter and requirement. And basically, as far as DLF is concerned, it is an end user's product. So speculators and that particular thing, I feel at this point in time, I don't think we've gone after that for a long time. At least in my tenure, I can say that very clearly to you. So I think there are two very different markets here, sort of.
Okay. And just on your phase 5, Akash, so your Camellias has gone to, nearly 1 lakh, and now you're launching this mini Camellias, if I can call it, in Q4 or Q1. So now is it like phase 5 breaks the peg from Gurgaon and now trades in line with Central Delhi, South Delhi types, or is that something you think is structurally now that the rate convergence between phase 5 and South Delhi has finally happened, or?
Yeah. DLF 5, now you should be worried to compare it with Mumbai. What you're saying, Central Delhi. So definitely, Saurabh, I mean, about time, the kind of work that we've done, and it's got accolades. And I say it with pride as an Indian. I mean, first DLF, and then of course, the kind of product that has been done, and the ecosystem that is being kind of created. It is, today, when foreigners come or people from outside, NRIs and all, the first thing, it's like the Beverly Hills of India. So yes, DLF 5 will see that, because also a hell of a lot of infrastructure, as you've seen, the social fabric is very strong. The kind of community that lives in DLF 5, I can safely say, half of India's GDP is kind of contributed from the kind of people who are part of the community there. And the good part is people love, staying there. So as far as that is concerned, I see a lot of going forward. Also, it's become the choice. I mean, today, if I can share this data also quickly with you, any expat who's coming into the country, and when they come in, they 6 months before that, their first choice when they come for these recce visits is to see where they're going to live. And whilst Delhi is an option, Vasant Vihar and other colonies, DLF 5, the golf links, DLF golf links is the most preferred choice. And this I'm saying you can pick up from any data, any relocator companies and all. So today I see that going up, and with the entire ecosystem that is being built, and especially the social infrastructure, I think it is now becoming the go-to place for by choice to live there. So once, first it was something that we were pushing. Now it is more of a pull product. So I think again with the demand and supply syndrome, what's going to happen is that you will see this definitely going up. As you see, a Magnolia today is trading at about almost 55,000 to 60,000 rupees a square foot. That's about 35 crores to 38 crores, and where it was earlier. So these are all very latent demand. This is nothing. I don't see this as a volatile kind of a thing. I'm seeing this as people who have very few options of communities like this. It's like akin to a central park where you have 500 acres of a green lung right in front of you, and then of course the security system and everything else. So I think that's where the demand will be. And second, you've been hounding me for 5 years on launch pipelines and all. So what Mr. Tyagi must have just told you must be music to all of your ears, hopefully, that now DLF pipelines are ready and things are happening. So I think that's something that we are concentrating on. And as Vivek said, margins are something which is extremely dear to us. Our projects will be launched only subject to what conditions are, and margins will prevail over any gross numbers that we ever want to quote. So that's where we are, sort of. We're getting there.
So, thank you and happy Diwali. Thank you.
Thanks,
Happy
Saurabh.
Diwali.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I now hand the conference over to Mr. Ashok Tyagi for closing comments.
Thank you. I mean, there's not much that I can say after that Akash's that rousing speech just now, frankly. But, honestly, I think this hitting net zero debt was a very important sort of, it was almost an emotional target for many of us over the last 8, 9 years, as you know, and we've taken a lot of steps in the last few years on this. So it's great that we finally hit there. I think this, the future does foretell a series of strong cash flows and strong launches, hopefully. The Rentco, is doing an exceptional job in terms of its leasing pipeline, its build out of new capexes, its certifications in all of these ESG and LEED certifications. So I think all in all, I think we are in hopefully a good place, and I just hope that the markets continue to be positive, and hopefully look forward to the next quarterly interaction. Thank you.
Yeah, thank you.
Thank you.
Thanks.
Thank you. On behalf of DLF Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.